Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. Joining me is Phil Mackintosh, Chief Economist at Nasdaq, for an update on the latest COVID-19 news, the U.S. and global economies, and how investors are modeling out the impact of coronavirus. And Phil, online brokers, it seems to be they're enjoying this COVID-19 lockdown as data shows investors are flocking to the U.S. stock market.
Yeah, so it's kind of interesting when you look at the new account data that came out in their Q1 announcements and looking at the levels of trading activity. It shows a huge spike in March and April. Remember, commissions went to free around about October, November last year. So that seems to have helped trigger some new accounts, but really the number of new accounts shown in the chart today and just looking at the activity that seems to be coming through retail brokers is quite significantly higher than it was this time last year and most of last year. And I think one thing that's interesting to think about is data seems to suggest that retail traders are a pretty significant part of the US stock market. They're not insignificant compared to mutual fund trade volumes, and they're actually probably close to 10 or more % of the total market trading that goes on. So it's a significant portion of the market already. And obviously, if there's a whole lot of new accounts being opened, that could be providing some support to the market. And we've been talking about valuations. Probably the sell-off got a lot of people interested in buying stocks, but they might still be actively involved.
Yeah, and moving along, you also point out that gold is rallying now, which is a little bit unusual when you look at it relative to historical correlation.
Yeah, gold's typically kind of a safe haven play. So you would have expected gold to rally back in March when the stocks were selling off. And we talked about the fact that back in March, everything was for sale. And you can see that dip in gold as well in that chart. Gold was for sale, bonds were for sale, treasuries were for sale, and stocks were for sale. It seemed like the only thing people wanted back in March was cash. But since then, gold has recovered. So have stocks to a large degree, but gold is actually getting back to multi-year highs. I guess there's a couple of things going on. Obviously, there's a longer term uptrend here that started back in I guess you could say 2015, but definitely in 2018 onwards, gold's been strengthening. There's also the fact that the amount of stimulus coming through the market now could, in theory, lead to inflation, and gold is typically an inflation hedge. Or the contrary is people are actually a little bit more worried about the market in the future and where the economy is going than it seems from looking at stocks. I mean, obviously, bond yields are still extremely low. And maybe gold is actually sort of signifying that there's a lot of people in the market that aren't in stocks that are worried about how long the recovery is going to take.
And speaking of stimulus, we can see in our next chart here that not all stimulus packages are the same.
Yeah, and there's an interesting other chart that you can see the arrival rate of the stimulus. In 2009, it took over a year for all the stimulus to filter into the system. And we had things like TARP, where we rescued a lot of the banks from liquidity crisis and the car manufacturers from liquidity crisis. This is totally different. Pretty much all of this stimulus has happened in the space of a month. It's getting close to $4 trillion, which is a ridiculous amount of money when you think about it. It's around about 20% of our GDP for the year. And a lot of it's gone into job retention, unemployment insurance, the sorts of things that are really direct cash payments to workers compared to what happened back in 2009. So the workers are getting a lot more support, which makes sense because they've been forced to not work to a large degree. But it just means that the way the spending is going to filter through the system is also quite different. So rather than supporting balance sheets and sort of helping companies survive credit crisis, this potentially is putting some money in people's pockets and keeping them liquid and keeping their confidence higher.
Now, speaking of inflation and deflation, we can see in the ETF scorecard that the silver ETF tops the list this week.
Yeah, it's interesting considering we're just talking about gold. Silver is another precious metal, and this is a little list that we put together that looks at ETFs that have strongest returns, whether it's positive or negative, trading quite a lot of value, and also trading relatively high volumes compared to normal. And we sort of blend those scores together. And yesterday, silver was actually the ETF that came to the top of that list. So probably people are playing precious metals, gold and silver at the same time with the same thematics. It's also interesting just to watch this over time. You can see you've got energy in there yesterday as well. We've seen a lot of USO trading back when the oil roll happened a month ago. In the last couple of days, we've seen Jets, the ETF that has airlines in it, pretty strong, pretty active, as well as news comes through about increases in airline traffic and additional routes being put on. But also today, I think what you're seeing is some small cap and value-y kind of tilts coming through. So people are starting to look at those really beaten up sectors. Both have underperformed for years, and it does seem like maybe people are starting to give them a look.
All right, in our final chart here today, we can see China is working its way back to normal, which is a good thing, but not necessarily if you look at it through the perspective of pollution levels.
Yeah, and I guess this is a data point that's a little bit more reliable in terms of how much activity is happening in China. So a lot of the pollution levels are pretty much back to completely normal now. We've talked in the past about how subway ridership still seems low. It looks like cinemas are either closed or just no one wants to go and sit in the cinema together. But this seems to show that factories and a lot of industrial activity in China has rebounded pretty strongly. It would be great if that happens around the world. Obviously, China got the new caseload under control a lot better than pretty much anyone else, and definitely better than the countries that have been less strict about lockdowns, like Sweden, the UK, and the USA. We talked yesterday about the risk of a second wave, and we looked at Iran and what's happened there. This is the focus, I guess, for us for the next few weeks, is as we start to open the US economy. Will we see a strong recovery like China seems to have seen in the production and actual activity levels and retail spending, or will we see an increase in another spike in cases? And so that's the data I'm going to be focusing on for the next few weeks.
All right, Phil, thanks for joining us as always on Trade Talks.
Thanks, Jill.
All right, and thanks for joining me. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.